Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And they said to me, Andrew, I don't think I have any other option than to put my money into some bond funds and hope that I don't lose some principal to get the income that I need for retirement.
We don't believe in hope, AAA. That's the crazy thing about these things, right? We call it the universe of income generating alternatives, and people have never even heard of these things. Professional people, retail people, right? And what they do is they allow you to have a more robust portfolio. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. And welcome back. People don't know what people don't know. So that's why we're coming at you today. And today's topic is building a robust portfolio. And so I'm really excited about today's show. Daniel, like I just said, people don't know what they don't know, right? And like you said, people in their industry, professionals don't understand this because they're not taught about it, right? The Wall Street's model, stock market's model is to have as much of your money in the market for as long as possible because they make money if the market goes up, down, or sideways. So therefore, they don't teach anybody in their organization and below them what these other things are because they don't make the kind of money that they want to make from these kinds of things.
I have conversations with people all the time, people in our industry, people outside of our industry, and they're always surprised on the types of things that are available, right? And what we say is it's because there's not a lot of professionals in it arbitraging all the deals out. There's always deals. We're always being able to pick up deals for our client. But the amazing part is it's while lowering the risk. And we hear all the time, well, I don't want to be in the market. I don't want to be in the market. I'm scared of that. I don't want to lose my money like I did in 2008. And some people are past that. Some people are not, right? But the point is that we're going to try to bring across today is you don't have to participate in what everyone's telling you need to be in. You don't have to participate in the bond funds. And we'll get into why they're a shortcut and they're taking away your two guarantees, right? You don't have to participate in market volatility if you look at these things that we're calling the universe of alternatives, right? The universe of income generating alternatives.
Daniel, I'm reminded of the situation where, somebody hit us up on the internet and we had these conversations. They ended up becoming a client, and I'm going to call him Jim, right? So Jim says, Andrew, I knew this had to be available somewhere, but I haven't been able to find it. I knew I should be able to get 5 or 6% dividends and interest on my stuff. But I talked to the Edward Jones guy, and I talked to a friend of my son's, and I talked to all these people, and they all said, no, there's nothing like that available. And like what we were just talking about, the people within the industry, and the egregious thing, right, is that I remember talking to one guy who's been in the industry for over 20 years, and he didn't understand the difference between a bond fund and an individual bond. And when I educated him on that, he was amazed at the difference and how much safer individual positions are rather than bond funds and how much better they are for people's portfolios. So people always poo-poo bonds, for instance, and bond-like instruments, but that's because they don't know what they don't know. They don't know how they work, because if they knew how they work, they wouldn't be saying that.
It's crazy. I mean, you and I were talking, we were beating the table, right? We were pounding on the table in October of 23, because we had all these kinds of solid balance sheet corporate bonds that we could get somewhere between 7.5%, 8%, 7 to 8%, right? For not junk, not low grade stuff, solid balance sheet stuff. And people, like you said, are always talking, poo-pooing, corporate bonds are bad, this is bad, corporate credit's bad, this is bad, that's bad. But it's like, you have a mathematical certainty that you're going to get that 8%. The only way you don't is if the company completely goes bankrupt, right? And then you still have some guarantees to get your money back. And people will compare that to equities, and they'll be like, well, equities are always better. And it's like, well, the S&P has averaged 9% over 150 years. So you're 8% bond, but how many drawdowns of 50% plus have you had in that 150 years? I mean, there's been 40% or more drawdowns just in my lifetime. You don't have to go through that. So to get that 9%, you have to stomach those drawdowns. in my lifetime, those 40% drawdowns or more.
Right.
You have to stomach that to get your 9%. And we're talking about those, in this scenario, those corporate bonds where it's a mathematical certainty, right?
Yeah. Right.
You have a guarantee, you have a contract stating that they're going to give you this money. And as long as they're in business, you get that money for 8%.
Yeah.
I'll take that all day
no-brainer.
long. I don't know about you.
I mean, we're talking like a third of the risk, right? Or is it somewhere much lower than half risk?
Well, you mentioned the key word at the beginning. You said they're hoping. And that's maybe what we want to bring out today, right? Is switching from a hope model, because we hear investors say it all the time and they're not even conscious when they're saying it. They say, I hope we do well, or I hope that is. And we want to help our clients move from hope that markets keep going up, hope that things continue to do what they've done, to a pay me, right?
Yeah,
a contract. Right. And real estate people understand this, right? AAA, because they have a contract. They get a tenant into their place. They have a contract with the bank, or they have a contract with the property that they own. And then they have a contract with the tenant, and they know when the tenant has to move out, or when the rent is due, and how much is, and what happens if they don't pay. And it's all in a contract.
Right. That mathematical certainty, that's really a thing. I think maybe we should do a show on that sometime. Anyway, you're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is building a robust portfolio. Today, we have a paper to go along with this to help educate you a little bit more on this, and we're going to be talking more about this in a minute, but it's called TR equals I plus G. TR, total return, equals income plus growth. And that is how you figure out, that's the formula for figuring out what you're actually returning, what you're actually making on your money. And the two go together hand in hand. When people are looking at the S&P 500, the thing that makes S&P 500 so big and so do so well over time is the I plus the G. Is if you just do the G, it's not near as effective as adding the I to it. So this is a great paper that will help educate you a little bit more on that. And you can have it for free by calling us at 800-725-7616. 800-725-7616. U.S. and Financial Strategy with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic, building a robust portfolio. So, Daniel, this robust portfolio that we're talking about is so important, right, to people in and close to retirement, because retirees' number one fear is running out of money before they run out of life. And rightly so. And that's why you have to be able to switch. You can't keep doing things in your retirement that you did pre-retirement. It's a different time of your life, both physically, financially, intellectually, all these different things, recreationally, right? All different in retirement than pre-retirement. So that's why it's so key to make sure that people have more than enough income to live the rest of their life the way they want to, rather than the way that they need to, because they only have a little bit to build a robust portfolio.
Yeah, exactly. Let's talk a little bit about why it's so much different, right? So when you go to work, you collect a paycheck. And so your investment assets, nobody likes to look at their 401k and see that the value's down, but most people are putting money into their 401ks. So if you're working and you're 30, you're 40, maybe even you're 50, right? You're putting money into that 401k. You don't like seeing that. You close your eyes. You don't look at the statements. You keep putting money and you're buying lower.
Mm-hmm. Mm-hmm.
You don't need the money. You don't have to take money out. So you're okay because you have a paycheck. Well, when that flips around and now you're getting close to retirement, or you are in retirement and you're either going to need a paycheck or you need a paycheck because you're no longer going to work, or you're not going to go to work in 5 years, right, AAA?
Right.
Now what do? Now you can't just cover your eyes. You can't just not open up the account statement, right?
Right.
So what do? You look at changing strategies from that hope strategy of, I'm going to actually hope markets come down so I can buy lower, right? There's a lot of young people that are like, markets are crazy and I need the markets to come down so I can actually buy some stuff and make some money, right?
Right.
That might be crazy for people listening to hear, but there's a lot of 30-year-olds who are like, you know what? It'd be nice if markets came down long enough for me to be able to buy some so it could come back up, right?
So they're sitting with cash on the side, kind of. They must be,
or they have good jobs. They don't have cash right now, but they have good jobs, so they have income, right? It's the same with the housing market. There's lots of young people that say, "I wish housing would come down so I could buy it." Whereas it's a different story when you are in retirement, close to retirement. You don't want that stuff to come down, right? Because you need it, or that's your security blanket, right? AAA.
Right.
That's the security blanket, is those assets. So if you got $2 million, if you got $1 million and it cuts in half, now you've got $500,000. That does not feel very good if that's all the money you have. You went from $1 million to 500,000.
Yeah.
Right.
Right.
And you've seen this. You've seen people who have gone through this over and over again.
Right. And people forget about that, Daniel. They forget. It's been so long since their portfolios have done that they forget. And that's what we're trying to remind people of, that could happen again. And if you're in or close to retirement, you need to pay attention. You need to do something about that. If you're 50 years old, especially 55, 60, man, you need to really be watching it, because I'm in my fourth decade in this business, as you well know, Daniel. And I talk to a lot of people, and not once, sometimes there's aggressive people, aggressive investors, sometimes, and most often the people I talk to are conservative investors. But I'll tell you, I don't care. Even if they're aggressive investors, they admit that they are more conservative today than they were when they were 40 years old. Right? So the older you get, the more conservative, because the more money you have and the more interested you are in preserving at least some of that, more of that than you have ever been before. When you were young, didn't have a lot of money, that wasn't as important. But as you develop more money, that's important. And what I'd like to maybe try to speak to, if we can, somewhere in here about building a robust portfolio, Daniel, are those people that they leave a job and they leave their old 401k behind and they think it's working for them. So I'd like to, in the next segment, to get time now that we take a break. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is building a robust portfolio. And we have a book to go along with today's show that helps you understand what a robust portfolio is. It's called Common Sense Income Investing. And a lot of people don't understand, as we said at the beginning of the show, because there's not a lot of education out there. Wall Street Journal, just a lot of different things don't talk about these. They're out there and they're very prominent. They've been around for decades and decades, what people used to do in the 50s, 60s, and 70s. But today, there's just not a lot of education. So this book, Common Sense Income Strategies, will help you understand how you can start the pieces of building a robust portfolio. Don't try this at home. Because you can't, unless you're watching this stuff all the time, which most people are not able to do, not willing to do, not wanting, don't know how to do. It takes a lot of education to do, but this book will be a primer for you for understanding how that works. You can have that for free. Common Sense Income Strategies to the next 5 first-time callers, 800-725-7616. Or if you're one of our clients, please ask for it by name, Common Sense Income Strategies. 800-725-7616, and we'll be right back after this.
The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
So Daniel, recently I was talking to Michael, another advisor on our team, and he was telling me about how he was talking to somebody who has a dormant 401k from an old company. And the guy is, I don't know, maybe 55. No, I don't think he's 50 yet. I don't know, he's a younger guy. And I said, Michael, make sure you tell the guy and talk to him about how that is dormant and it's not doing anything for him. He's just riding with the market. Michael says, yeah, Andrew, I have already. So he's right on the same page with us, which is great, right? But what happens is people just leave their 401ks, and then the only time they make money is if the market makes money. Now, you related, Daniel, earlier about going to work, and who here in our listening audience would work and be willing to take a paycheck only if his employer made money? Not a lot of people listening to the show would be willing to do that. They want a paycheck every week, every pay period, right? So with that, this robust portfolio we're talking about is getting paid every pay period. So if this gentleman rolls over his 401k into IRA and builds a robust portfolio so that it can continue to grow, put that money in every month the way he was putting in when he was putting his paycheck in. And now, since he's at that company, he's not putting any money in. So that's ridiculous. That's simply ridiculous. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about building a robust portfolio. And AAA, we see that often. We know that the government knows about this, and that's why they allow for people who are 59 and a half, typically, right? 60 years old.
Yeah.
They usually have a provision inside their 401ks where you can roll it into an individual IRA or Roth IRA. And then you have the handcuffs come off, right? You're allowed to invest in anything instead of what your plan sponsor or your company decides you can go into. And the companies in 401ks, they need to allow you to invest in things that keep them from being sued. So I don't care how good your company is, listening audience out there, people listening to this, I don't care how good your company is. They have to make sure, and the bigger it is, the more they have to do this, they have to make sure that they're not being sued. Now, if you're in a company with like 5 people, maybe they're not so worried about that, right? But they might be buying it. They might be buying the plan from an administrator that's doing it for big companies. And so it's the same plan, and that plan was designed so that the employer doesn't get sued. And so there's a lot of good things that they don't put in that plan, because if something went wrong, the employer is on the hook. Your employer is on the hook as opposed to you. You still lose the money,
right?
But they're the ones who are going to get sued. And just because they get sued doesn't mean you're going to get the proceeds of the lawsuit. It just means they're going to get sued. So that's what they're worried about. So the government says when you're 60 years old, typically you can roll your money out of your 401k plan into your own 401k account. You're still responsible for it, just like you were with your 401k. The difference is you don't have someone over you saying you can invest in this, you can't invest in this. We think this is good for you. We don't think you're smart enough to invest in this, right?
Yeah. Right. Exactly. These big companies, they think that they're protecting you from yourself. And it's a terrible thing. So exactly, Dan, you're right on track with that. And that gives people a lot more options so that they can build a robust portfolio, one that's still going to work for them hard while they're, and it's still going to grow, because if you invest for income, you reinvest that income, and it makes the thing grow. And you're not worried when the market drops. You're able to still pick up some growth from that. But that gets back to what we're giving this paper away, Daniel. The TR equals I plus G, right? Total return. When people are talking, if they make, you mentioned earlier, the S&P has done 9% over 150 years per year on average. Well, 2 to 3% of that has been the I, and the balance, the 5 or 6% of that or whatever, has been the G. We're going from share price, right? Share price going from, for instance, $10 a share to $11 a share, $12 a share. The problem with the growth aspect is it can turn to an L, which it can go the other direction and go from $10 a share now to 9, down to 8, and so forth. If the income is coming in, and when it goes down to $8 a share, buys more shares, then when it comes back up to $10 a share again, well, now you've already made money. So it's a beautiful combination. That's why we always use this equation of TR equals I plus G. And we're giving that paper away today on this show for anybody that wants it by calling 800-725-7616 for your free copy of TR equals I plus G, a paper that will help you and educate you to be able to understand better how these things work and the very basis of and foundation of building a robust portfolio. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is building a robust portfolio. If you want that paper, TR equals I plus G, ask for it by name. TR, total return, equals I, income plus G, growth. 800-725-7616. Daniel, when we've got this paper, we're giving this away. People don't know what people don't know. Building this robust portfolio is a huge thing. And many times I started off the show with the idea of somebody thinking that, oh, bond funds are going to help me build the portfolio that I need in order to have the income that I need. And I saw a guy, and I talked with a gentleman that was showing me a bond fund that was paying high. It was over 6% on this bond fund of dividend. But it was a bond fund, and he didn't realize how much risk he was taking on for that, as opposed to the portfolios that our clients have that are producing about the same, but less than half the risk of what that fund was. And that's what's the beautiful thing about this, is the lowering the risk and increasing people's return oftentimes.
Yeah. And part of our problem with bond funds is you're not owning bonds. You buy bonds because you've got two guarantees. Why would you buy a corporate bond? Why would you buy a government bond? You buy those bonds because you want the two guarantees. And those two guarantees are, it says exactly how much they're going to pay you, and it tells you how often they're going to pay you. They're going to pay you once a year. They're going to pay you twice a year. They're going to pay you 4 times a year, whatever that coupon says. So that's in the contract. How often and what they're going to pay you. So they're going to pay you on a $10,000 bond. They're going to pay you $6,000 a year. You can depend upon that, or $600 a year, right? On a $10,000 bond, $600 a year. They're going to pay that to you. You have a contract that says they're going to pay that to you. Now, the bond, that 10,000 could go up in value or it could go down in value, depending how many people want your bonds. And right now, people want your bonds. So they're going up, right? They're going up in value. So now that $10,000 bond, you can't probably buy for $10,000. Now, today, it probably costs $12,000 for that $600 a year, right?
Wow.
So they go up and down based on that. But what we know is at the end of the period of time, you're going to get your $10,000 back, right?
End of the contract period.
Some event where whoever's you have the contract with can't pay you. Right. And that's what you do research on these things for.
Right.
Is so that you find companies or governments that will pay you back, right?
Right.
So if that's 4 years, hop in.
Well, I just want to say, right, when you're talking about this, you're all in line with this. This is great. And that's what we look very much at. And we hire companies, a rating company is paid by us rather than paid by the companies that are rating them, right? To tell us if they're good companies. We check the companies when we go in to make sure they're good, and we continue to check them. Like during COVID, at the beginning of COVID, we had Hilton Hotels, and Hilton Hotels is a good company, but we didn't know what was going to happen with the hospitality industry. So we sold it because we wanted to be able to protect our client's portfolio. And then, it turned out being okay and everything from that standpoint. We don't just look at it when we buy it. We continue to look at it to make sure it's still as good and strong as possible. And that's a big piece. Earlier in the show, I said, don't try this at home. People don't know how to research this stuff. You need a certified portfolio manager like Daniel, or a certified financial analyst. And we have all those. We have a depth of bench to be able to help us to be able to do exactly that. So go ahead, Daniel.
Yeah, exactly. And like you said, AAA, this is all part of building that robust portfolio. So you can go buy a bond fund, and the industry says a bond fund is better than individual bonds because you don't have to do the individual research on the bonds. You just buy the fund and you put it in the portfolio. The difficulty with that is you just gave up those two guarantees I talked about, where you know exactly what it's going to pay you, you know when you're going to get paid and exactly when it's going to pay you, and you know when they're going to buy it back from you. So we could say, I want this cash in 2 years, and we could buy bonds that come due in 2 years. And so you get all your cash back. Sometimes we might buy a 10-year bond depending on what's going on, right? And so it's all dependent. But what you get when you buy the bonds is you get a contract. What, in my mind, when you buy a bond fund, what you get is you get a company that owns bonds with limited upside, right?
Exactly.
Because the bonds can't go too far above their par. So you're not going to make stock like money, but you have stock volatility because you're not owning a bond. Right. You're owning a company that owns bonds.
Right. That's right.
And it's just
people don't get
disease of ease, right?
That's
people are buying those because it's easier because they don't want to do the individual research on the companies. Well, what you just said about buying these individual companies is it makes your portfolio more robust because you own a bond that you've done the research on, and you know what you're going to get paid and when you're going to get your money back, right? The other thing that it does is it allows you to manage it. So I said that 6% coupon right now, you might not be able to pay the $10,000 for the 10,000 bonds. The 10 bonds, it might cost you 12. Well, when you're doing your own research and you're looking at these individually, you just saw you made 20% of appreciation. So on our equation, TR equals I plus G, you made your 6% on the income, but you also made 20% on growth that wasn't counted, but you got it anyways. You can get both. And now if you manage these individually, you can say, I think I'd like to sell this, take my 20% plus whatever I collected in income, and either wait for an opportunity or I have a better opportunity here and do the same thing again. And that's a robust portfolio.
Yeah, you're absolutely correct, Daniel. That's a great thing, defining what a robust portfolio is, because if you guys, I just want to say what Daniel said a little bit differently. Daniel said, if you collect in a 6% coupon and you picked up 20% growth because you bought the thing for $10,000 and you're selling it for $12,000, and it's a 2-year period of time, all right, that means you're making 16%. Your total return on that is 16% per year. 32% total, which is 6% a year on the coupon, and then 20% on between what you bought it for and what you're able to sell it for. And so that's 32% divided over 2 years is 16% a year. And that's at like a third the risk of the stock market. So go ahead and tell me that fixed income is not good. If you say that, you obviously don't know what you don't know. And I'm glad you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what they don't know. And as they listen to us, we're going to be able to educate you on things that Wall Street won't educate you. Well, today's show is called Building a Robust Portfolio. We have a book to go along with today's show called Common Sense Income Strategies, but written by a friend, Mike Eastham, CPA, PFS, and Mike has done a masterful job in putting together this primer of a book to be able to help people to be able to understand the basics and foundation of a robust portfolio. So we'd love to put that in your hand for free to the next 5 first-time callers at 800-725-7616. 800-725-7616 for your free copy. The next 5 first-time callers or any clients that are listening, please call for your free copy. We'd love to put it in your hand. It's an easy read book and be a lot of, I think you enjoy it. So call now. We'll be right back after this.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategy with Andrew and Daniel Agemy.
Daniel had just described a mathematical certainty of bonds, where you buy a $10,000 bond and you know mathematically that it's going to be paid you $10,000 when it matures, and it's going to pay you whatever it is, 5%, 6% of dividend during that period of time. That's a mathematical certainty. When we buy it, we know what's going to happen for the most part, and we make sure the companies are good. Versus gambling or speculating. Right. And speculating is the hope side of things, where you buy something for $10 a share and you hope it's going to go at 11 or 12 and that you're going to sell it at $20 a share you hope for, so that you double your money on it. But there's no certainty in that. As a matter of fact, it could go from $10 a share up to $20 a share and back down to $5 a share. And that's where you end up selling it, which is a loss rather than a growth. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about building a robust portfolio. And AAA, when we're talking about a robust portfolio, we're talking about something that's stable and something that is paying you. It's not something that you're hoping you're going to earn some return. It's something that's paying you. Right? And that's very important when you're nearing retirement or you're in retirement, because you don't have time on your side anymore, right? You want to enjoy. You might still be young, right? You might be 55, 60, 65. That's still young. I think that's still young.
Thank you.
You don't want to spend 20 years waiting for your portfolio to come back and put off your retirement another 20 years. You saved up all this money. Don't make, because the marketing machine that is called Wall Street, you saved up enough money. Don't make them put your retirement on another 20 years. Hold another 20 years, not because you didn't do a good job of saving, but because you didn't get the returns, or because markets had a correction, or because it was invested incorrectly, right? That's what we're talking about with these robust portfolios.
Yeah, you're exactly right, Danny. And what comes to my mind is the idea of a robust basketball team, right? A robust basketball team that's up by 23 points, right? And they got 2 minutes left in the game. That's a great team, right? And what happens? What does the coach do? Oftentimes, the coach will pull out the first string, put in the second string. No, not doing anything crazy, not being aggressive, just run the clock out, right? And that's a robust team, a disciplined team that can make it happen, right? And that's what we're talking about, where maybe you put the first string in, you've grown your money, but now when you come into retirement, it's time to make sure that you're able to not do anything crazy and be able to have all the money that you need, more than enough money that you need to live than you want to live the rest of your life in retirement. Yeah. So how do you do that, Daniel, right? How do you build a robust portfolio? What's this based on? We talked about bonds, but I know it's not just bonds.
Well, I wanted to go back to what you said at the beginning of this segment, because you were talking about hope versus that mathematical certainty. And another way to look at that is, what type of investor are you? Right. Good point. Yeah. Really, folks listening, really think about this. What type of investor are you? Because we throw terms around all the time, but what do those terms mean? And what are you? Not what does your advisor think you are? Not what does your spouse think you are? Right.
And not how you have
not
your
what
money.
You hear on TV, because that throws a lot of people off. I hear all the time people talking about they're watching one of the big financial media companies, right?
Yeah.
And they're taking advice from them. They are not talking about retirement planning. They are not even talking about medium-term planning. They are talking about day trading. They're talking about whatever's hot this moment. Yeah. Unless that's your full-time job, it does not make sense to try to be trading as much as they're talking about. It does not make sense to try to hop on the bandwagon. That's the opposite. What they're talking about is the opposite of a robust portfolio. It is a roller coaster.
Right. They're entertainers. They're just trying to get your attention. They're entertainers. They're not investors. They're not professional investment people. They're entertainers. They're media. They're marketing, like you said, Daniel. And that's really good where you're on that, is that the robust portfolio is something that's going to move you ahead and do well by you. Well, so
what the listeners need to answer is, they need to answer this question. Are you an investor or are you a speculator?
Right.
And now everybody's going to say investor, most likely. Everybody's going to say investor. But if you're an investor, what makes you an investor? Are you trading? Are you doing the individual research on your company to say that this company is going to be making more money in the future than it is today? Are you investing in a way that the company is paying you? You're getting paid no matter what's going on. That's an investor. The speculator is, I think this is going to go higher. I heard a tip about this company, right? I've got all my money in these different funds. I don't really know what they are. That's a speculation, right? Those are speculations. So are you an investor or are you a speculator? Do you feel like you want to get paid? Do you want to get paid? Or do you want to hope that your portfolio is higher in a year or 2 years or 3 years? That's the difference between an investor and a speculator. So if you're an investor, that's who we're talking to, because speculation is a completely different thing. If you're an investor, then you have to look at your portfolio and say, is my portfolio, is the way I'm managing my money, is the way that my money's being managed for me, is that set up in a speculative way, a hope strategy, or is that set up in a way that's going to pay me?
Right. And Daniel, what I would add to that, are you the CEO of your portfolio, or are you like along for the ride? Right? Because investor is going to be understanding what's going on with the portfolio, going to be able to make smart decisions, going to be educated to do that. Doesn't have to do the day-to-day stuff, but is going to be involved with that from that standpoint. And that's good stuff. We have a paper today for those who are in our listening audience. Today's show is Building a Robust Portfolio with Andrew and Daniel Agemy on Financial Strategies here. And today's paper that we're giving away is an introduction to the universe of income-generating financial investments. And we love to put that in your hand to all these different things that are involved with building a robust portfolio. This is the fundamental, foundational aspects of building the robust portfolio. Because like I said, don't try this at home on your own. This is to educate you so you can be the CEO of your portfolio. And we love to put that in your hand for free by calling us at 800-725-7616, 725-7616. Love to give you this introduction to universe of income generating strategies. You listen to Financial Strategies. Andrew and Daniel Agemy. Today's topic is building a robust portfolio. Yeah, people don't know what people don't know, Daniel, and that's great. What kind of investor are you? Think about that and do that congruently. And it's not how your money is currently invested, because that doesn't have to do with this. It's what part are you playing in the process? And that's a huge difference. Like the difference between
things change.
Yeah, well, right. But it's like the difference between FanDuel and being Robert Kraft, right? Of the New England Patriots, right? Where Robert Kraft is an investor. He's investing in, the Patriots. He has say in what's happening as far as who's the general manager, who's being on the team. He has a say in that versus FanDuel it's just picking and hoping that you're picking the right team, that you're going to be able to make some money off thing. And that's called gambling, right? And that's what a lot of people do with their investments. Like the difference between Warren Buffett, who has a say, he buys these companies and he has a say, he gets on the board of these companies and he has a say in what the companies are doing, versus you buying a mutual fund and you don't even know what the mutual, and how many people do we see, Daniel, that have like a zillion mutual funds, and they probably have things like Facebook and Amazon and Google they have 20 different funds, and those three companies are probably like in half of them at least, right? It's just a collection of stuff. And so that's big. But anyway, the point is, how do we build a robust portfolio, right? What's involved in building a robust portfolio? We talked about all around these things today, Daniel. And we talked about bonds. There's three kinds of individual bonds. And we're talking about individual bonds, not bond funds, if you just joined us. And because as things are said, is that bonds are safe compared to stock, and they are, because you have the guarantee that upon maturity you'll get your money back as long as the company is a viable company. So if we're talking the U.S. government, there's nothing stronger than that. Our industry sees that as being the strongest thing there is. But the other guarantee that goes along with it is the amount of interest that you'll be getting during that period of time, the amount of interest that's going to pay you every year. What's next, Daniel?
Well, what's next on
what other
what?
things? What other things are involved in instruments are involved with building a robust portfolio?
Well, you gave the white paper away, AAA.
Yeah,
you
but
gave the white paper away. So that paper you gave, the Universe of Income Generating Financial Strategies, that actually breaks it down for folks. So they can call it and they can ask for that paper and they can
And the book,
see
too.
some of the things right on the paper. We've got some secret sauce, so there's some other stuff that we don't have. Some of the other stuff that you got to either talk to us or listen to our show to find out. But we got some other stuff. But yeah, it would be like you said, those bonds, those individual bonds. Mm-hmm. We go into the preferred stocks or preferred securities, which people don't talk about a lot. And inside of the preferred stocks or the preferred securities, there's other things. There's baby bonds. Some of these things pay special dividends. So those who have a lot of non-qualified money, and I'm sure the people who have big non-qualified money know who they are. They know what they're talking about. Some people might not know what I'm talking about, non-qualified money, but those people who have a lot of taxable money, they know who they are. And so these, you can get much better yields than call it a municipal bond. Now, a municipal bond has no tax, right? If it's in your state, but you could get potentially double the income that you can get on that. And it's still more tax efficient than if you're buying a CD or you got your money in a money market account or things like that. So in the preferred securities range, you get a robust portfolio because you still have promises associated with these things. When you get into the baby bond section, you have the guarantees where they have to buy it back from you. And these are usually in a shorter period of times. Within less than 10 years, they have to buy it back from you, right? So you still get these nice income payments, but you have some promises or guarantees and tax benefits as well.
Excellent. Excellent. I see it's time for us to take a break. You're listening to Financial Strategies. Andrew and Daniel Agemy. Today's topic is building a robust portfolio. And this is for retirement, was what we're talking about. We're not talking for if you're 20 years old, 30 years old, 40 years old, building a robust portfolio for you. That's a different deal, right? That's a whole different way of doing that, everything. This is for those people in and close to retirement. We have a book that we'd like to give you, easy read book, written by friend Michael Easom, called Common Sense Income Strategies. And this will help you understand these things a little bit more in depth. What's part of the foundation of a robust portfolio and how they work. We'd love to put this in your hand for free by calling us at 800-725-7616. If you're a client, please call it. Otherwise, if you're not a client, first-time callers, 800-725-7616. Call now.
Financial Strategy with Andrew and Daniel Agemy.
AAA, we go through an educational process with our clients, right? Where we go through these exact things, the universe of income generating alternatives. And I was going through with a new client the other day, and she had a great question. What do you do for investment research? It seems impossible to know what companies are going to be around in 5 years, let alone 10 years. And when you're talking about buying equities, you got to be talking about a 40 years plus, right? That's what they say the duration is on an equity or a stock is 40 years.
Whoa.
So I said, you know what the good news is? We're doing the due diligence on these, but we don't need to worry about if the company is going to be around for 40 years. We don't need to worry about that. All we need to worry about is that the company is going to be around long enough to give you the return of your principal, right? So we said when we buy a bond, they give us our money back in 4 years or 6 years. We just need to know that they're earning enough and have enough on their balance sheet that we get paid our interest and get the return of our principal. And we're not looking at 40 years. That's how, when you do the individual research, it's so much easier. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is building a robust portfolio. And people don't know what people don't know, so glad that you're here listening to us. Daniel, that is such a relief, I find, to our clients to recognize that they don't have to worry when they hear the stock market's going down, they're on vacation, whatever the case may be. They don't have to worry about that stuff. And that's such a relief on our side, because we can focus on other more important things to building people's portfolio, whether or not the stock is going to go down or the company is going to be in business or whatever the case may be. Right. So, so that was this amazing thing, that the duration on a stock is 40 years. So that's really the long term. And the long term for most of these people in a closer retirement is behind them rather than in front of them. I mean, what 65-year-old wants to wait 40 years for the duration, for the length of the bond to work through to make sure that he's going to have some money or she's going to have some money? That's not a great position to be in.
Yeah, exactly. So when we're going through, we said we weren't going to get into all of these things, but when we're going through these instruments, right, the universe of income generating alternatives, you talked about the CDs, the government bonds, the fixed annuity, I think you mentioned, but that works the same as one of those bonds. It's from an insurance company instead of the government, right? The insurance company says, I'm going to pay you X amount, 5% for 5 years.
Right.
And the one cool thing about the fixed annuity is that you get tax deferred growth. So if you put $100,000 in there, you earn $5,000. The good news is if you don't have to pay tax on that $5,000 until you take it out of that annuity. Whereas if you did the exact same thing with the CD, I would argue that the banks are not as strong as the insurance companies, but what would happen at the end of that first year is you would have another $5,000 that's taxable to you. And so you can do some planning when you're looking at these fixed annuities better than maybe a government bond or a bank CD.
Right. And like you said, those people with qualified money who they know who they are, right? That means that they're not being taxed on that money while it's growing, which can be an thing. Because I've seen people get $25,000 a year taxable just from the interest on their investments, which if they weren't paying that tax on that $25,000, they were still making $25,000, but not paying tax on it. That can go a lot farther, which is a beautiful thing. And then when you're talking about the annuity range, there's the fixed indexed annuities that the principal is fixed, but it goes up. The interest is predicated upon what the stock market does. So if the stock market goes up, you make more interest than if the stock market goes down, you don't make any interest. So the beautiful thing is, if the stock market goes down, you don't lose any principal. You don't make anything, but you don't lose anything. So people really like that a lot. And those two kinds of annuities are the safe kind of annuities. And for those people that are listening, if you have an annuity, you really need to get a second opinion right now on that, because the government, the Fed right now is giving you a present that things as far as annuities go are in much better shape than they have been in years. And there's still some good deals out there that you can potentially improve your position significantly, make more money, get more money in your account, as well as get more income, all kinds of options that are available. So you owe it to yourself to get a second opinion if you have any kind of annuity other than immediate. If you have a variable annuity, a fixed index annuity, if you have a fixed annuity, our suggestion is to get a second opinion. You listen to Financial Strategies.
And these things all fit into that robust portfolio, right, AAA? Where that fixed annuity, the insurance company is backing up your money. They say they're going to make sure you don't lose anything. They're on the hook for that, and they're on the hook for paying you that 5% or whatever that may be. You mentioned the indexed annuity, and some people might say, how does that fit into there if it's connected to the market? Well, it's not in the market. It ratchets up with the market, but you get to keep your gains. And that's why we say that fits in that robust portfolio, because once you earn it, and it's credited to your account, you can't lose it. And I would agree with you, AAA. If you have an annuity, have us take a look at it because there's excessive fees inside of annuities. There's 4 different types of annuities, and 2 of them are really probably the 2 types that most people should actually be owning. And rates have gone up so much that you can probably go from maybe earning 2% to 4% or 8%. Like, it's crazy what has happened in the past few years because rates have risen.
Right. Exactly. Well, you're listening to Financial Strategy with Andrew and Daniel Agemy. Today's topic is building a robust portfolio, and we have a few minutes left. But before we get off, I'm still wanting to offer you this paper that we have available, The Universe of Income Generating Options. Love to put that in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of The Universe of Income Generating Alternatives. And you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Daniel, as we finish up here, that was great talking about those annuities and what people have available to them from that standpoint. What else do we need to put into today's show while we're talking about this robust? Oh, I know what I wanted to say about that was one of the things that the annuities allowed us to do is during COVID was to take money out of the annuities. The whole thing about investing is buy low, sell high. So we were able to sell annuities when they didn't lose anything, or take some of it out without any penalties and put it into the other income generating products that allowed us to be able to actually compound people's income and portfolio, because we are watching that all the time. Again, this is one thing that's very difficult to do at home for people that we're bringing to the table to be able to help people to have more than enough income to do what they want to do during retirement.
And that's where it goes into strategies, AAA. That's not the product as much as the strategy. And so when you're talking about those types of things, sometimes people forget how math works, right? And if you have a 50% drawdown in your account, you lose 50% of your money. How much do you have to earn to get back to whole?
100%.
Well, it's not 50%, right?
Yeah.
It's not 50%, it's 100%. And that's what you're talking about when you're talking about those strategies, where in COVID, when stuff came down, people had money where they didn't lose anything at all, and they were able to move it over. So even if they didn't get the whole move up, they're starting from zero. So all the move up is growth as opposed to the move up getting you back to where you were. And when you can do those just a few times every few years, it can really compound your money. And that's another example of that robust portfolio, because we like it when you don't lose anything, but you get to move back up with everybody else. Everybody else got back to even, but you got ahead. And those are examples of that robust portfolio we're talking about. So its strategy is not even just the product. And so we had a lot of people who were ultra conservative who did not want any market volatility. But when those deals presented themselves to them, they said, Andrew, Daniel, do you know what? I want to take advantage of these opportunities when things are selling off like crazy, and they were able to do that. So it all fits into the strategy, not just the individual investments we've been talking about.
Right. And it fits into being the CEO of your portfolio, being able to understand and have the information you need to be able to make a smart decision. Cool beans, man. That's some good stuff. I love talking about this stuff and helping people understand how they can be in a better position and be in the best position. And it's not something that is something to do at home. This is not something that most professional financial people do, unfortunately, because most professional financial people work with people 20-year-old, 30-year-old, 40-year-old, 50-year-old, 60-year-old, 70-year-old, 80-year-old, 90-year-old, and do some form of the same thing, but with different variations thereof, as opposed to Agemy Financial Strategies. We concentrate on the strategy for people in and close to retirement, 50, 60, 70 years old, 80, 90, 100. Has to be done differently. Well, glad that you joined us today. Yeah.
AAA. Somebody asked me the other day, how come you talk so much about income? And I said, we talk so much about income because AAA and I believe income solves a lot of problems, right? If you think about going to work If you earn 100,000 or you own 250,000, which one gives you more flexibility? Which one gives you more confidence? Which one gives you more opportunity? Obviously, if you're earning 250,000, it might bring some other problems, but it solves a lot of problems for you, right? And that's
Right.
exactly what we think about when we think about these portfolios. Even when you were talking about annuities, right now, annuities can pay a lot of income, and income solves a lot of problems. You don't have to spend the income. You don't even necessarily have to pay tax on the income depending how it's set up. But what it can do is it can give you a lot of optionality, a lot of flexibility, and a lot of certainty. And that's what these robust portfolios are all about.
Exactly. And that's why we say, if you want your retirement to be stress-free, invest for the I more than the G, right? Then that's the idea. Income solves a lot of problems. That's great, Daniel. Thank you for bringing that up. And listen, as we finish up today, today's topic has been building a robust portfolio with Andrew and Daniel Agemy on financial strategies. And we have a book to go along with today's show that we love put in your hand by our friend Michael Easom, CPA and PFS, Common Sense Income Strategies. And I'd love to be able to put that in your hand. Easy read book. If you're a client, please call for a free copy of that. If otherwise, if you're listening to our show, first-time callers, please. 800-725-7616. 800-725-7616 for your recopy. And we hope that you join us again or check out our podcasts and other ones, whether you look it out on our agemy.com, AGEMY.com. We have them there. YouTube, you can pick up. If you're listening to this today, you can also see us on YouTube from that standpoint, as well as anywhere that you listen to podcasts. And at this point, there's over 3 years worth of shows that you have available to you. And we love to be able to educate you. And we spend a lot of time, a lot of money to educate people so they can make a smart decision. Thank you for joining us. And remember, if you want your retirement to be stress-free, invest for the I more than the G.